Good morning, good afternoon. This is Rob Barnett with Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got from his normal perch, Patricio Alvarez over in London, though this is his last couple of days in London before he relocates to Madrid. So going forward, we'll see him from a slightly different location, but still part of the band. Swinging across the pond, we've got Fernando Valle joining from New York City metro area. And we are anticipating our colleague Vince Piazza will be joining us, though I think he's having a little bit of difficulty getting on. So we will keep him as a placeholder. Okay, so in terms of topics this week, one thing that I just want to flag is that we host or ask all of you, all of our energy focused clients, to participate in a survey that asks, your expectations on oil prices, when you think peak oil demand could occur. Lots of interesting questions. It should only take you a few minutes. I think it's 10 questions in total. So we will be including that survey as in the chat here in just a moment. And so I'd encourage you to take it, and we will be posting the results in a couple of weeks once we've had a chance to collect them, see what they say, and get them back out to you. So just doing a quick commodity check-in. Looks like Brent crude's in the low 80s at the moment, $82 and change. European natural gas, about 24 euros a megawatt hour, and Henry Hub is sub $2 still. So before we get into some of the company-specific work and research that colleagues have been writing and publishing over the last couple of weeks, let's start with just general commodity outlook. So Fernando, we'll come to you first. Want to just always get your pulse on where we are for Brent. I don't think there's been any change in story since our last check-in, but when you read the tea leaves, what's your sense? I mean, is low 80s the sort of comfortable zone for oil, or do you see material movement coming up in the next kind of 3 to 6 months on that one?
Yeah, I think my old boss used to say nothing stays sideways for a very long time. So we expect there will be a lot of fluctuations, and our bias is more to the downside, even though the last several flashpoints have been positive for crude prices. That's the Red Sea issues, that is just the rhetoric escalating in the Middle East, and then Saudi itself saying that they want to try to boost that price and canceling some of their long-term projects. But when we look at it, the face of it, a lot of positive news that have just been met with total disregard by the market. So even though we've had all these supporting evidences for higher crude prices, we're still here in the low 80s, with on the eve of an expiration of the voluntary cuts in March, and an inflation print that was well ahead of expectation. So when we look at the odds of an interest rate cut that were 97% in December, and now they're nearly zero for the March cuts, that really shows you the expectation for oil as well. So we like to say that right now, pretty much everything but oil in this case is essentially a play on the 10-year curve, and this is just playing out as we expected. As the odds of an interest rate cut diminish for the next several quarters and potentially beyond the summer, it creates a huge headwind for demand, and then that even with the flashpoints that I mentioned, create resistance for higher oil prices. We have to see, we talked about this after our trip to the Middle East. We have to see on how OPEC plus cooperation continues beyond March when the voluntary cuts expire. I'm sensing there's a little bit more frustration, both from the UAE, Saudi, and Russia, that they're burdening a lot of the costs, and it's not having the desired effect. So we'll see if they continue. But that is a risk that I don't think is mentioned significantly, that those voluntary cuts will expire and they have to renew them in order to maintain supply off the markets.
Okay, thank you, Fernando. Patricio, want to swing around to you. You've got a pretty provocative note out over the last couple of days, leveraging your fair value model for the European gas market. And you talk about 21 euros per megawatt hour being kind of where the fair value model pegs things. So tell us about that result and give us your expectation for how you're seeing things over in Europe at the moment.
Sure. So just to give a bit of context on the fair value model, this is a multi-factor regression where our data scientists, our colleagues in data science, kind of go through a battery of factors and kind of sees which ones have the best correlation. And what's really cool about this model is that it will select different factors over time. So for example, in gas, sometimes during winter times, storage tends to be a really important factor, and during the summer, it's not so much. So just giving that context, the main factors driving our model right now are carbon prices, surprisingly, and dark spreads. Dark spreads are the margin for burning coal for power. And given that gas is a substitute coal is a substitute for gas, those factors kind of make sense, and also show how low demand is, because usually storage would be a big driver. But that said, our fair value analyzer suggests that prices should be about 21 euros per megawatt hour at the moment, which is roughly 43% below what consensus is for the first quarter of 2024. And that just shows how anemic the demand rebound has been in Europe. We've had, again, a repeat of a very mild winter so far. Only one small cold spell a few weeks ago. Other than that, it has been very mild. Industrial activity, mainly in Germany, has recovered somewhat, but it's still very weak. And on the flip side, all these factors kind of support our view for gas storage. So we have a separate sort of supply-demand balance where we try and estimate what the end of winter storage will be. And at this moment, we think it will be more than 50% full. So again, for context, the long-term average norm is 33%. So we're still going to be roughly 20% above the long-term norm for storage. It looks set to be so by the end of March, which should keep sending bearish signals for prices. The only risks, I would say, the meaningful risks to our view are extended or escalating disruptions in LNG cargoes coming from Qatar, stemming from the conflict in the Middle East. And other than that, I mean, that would be the main risk, because I think talking about geopolitical risks tied to the remaining gas flows coming from Russia at this time is not very realistic. I don't think that the European Union has the will to sever the few remaining flows that we have coming in from Russia at the moment, or sanction LNG from Russia either. So that's kind of the picture. It seems like most of the risks are to the downside.
Patricio, let me just weigh in just quickly on that. For anyone who doesn't follow the European carbon market, we're at about 52 euros a ton right now. You zoom back a year, we were at 97 euros a ton. So we've seen a big pullback there. And it's basically a fundamental story. It's some of what you were just describing there, Patricio. So we've had a really big pullback in emissions, partly because of that decline in industrial activity versus where things were at historically. So if you just look at in a carbon market, it responds in a very similar way to the traditional energy commodities. There's a supply-demand balance, and demand is driven by the emissions. And so when you get a pullback in emissions, I think that's a big factor that explains why we've seen the price pullback. So anyhow, we will table that for now, perhaps swing back to it if there's interest. But Vince Piazza has joined us at this stage. And Vince, before we get into some of the company-specific research that our team's been working on over the last few weeks, I wanted to just get your sense on the U.S. natural gas market, given you look very closely there. Patricio just gave a fairly bearish take on what's going on in Europe. Henry Hub is sub $2 at the moment. What's your read? Is that the sort of fair price based on the fundamentals? And what's your outlook for gas as you look into the summer?
It's been a tough winter. It's been a very tough winter. It's been a rather warm winter. February being warmer than January. These 8 weeks, January and February, are the two key periods for natural gas, really for the entire year. If you can get January and February right, you're on a fairly good track. But you need that cooler weather. Production came back stronger, and the winter weather just really wasn't there. We actually came into the winter season with storage fairly benign. I mean, we were getting pretty close to reasonable levels on storage. We had a good uptick in weather demand in January, and that really reduced the surplus, but there was not as much follow through. And February did not help at all. So January and February really hurt prices. Do I think prices should be higher? I do, and we are on record as saying so. We were much more optimistic about Henry Hub coming into the winter season. In fact, we were quite fortunate over the last few years of getting this summer winter trade fairly correct and doing rather well with it. This winter has been the complete disaster, and we'll say that we were quite wrong. So, you know, the good comes with the bad, right? We'll take the victory lap when it comes, and we'll also fess up when we get it wrong too. So we have no issue doing that. It's interesting today, the companies that have reported, whether it was Chesapeake or Comstock, offering up cuts in output going forward. So that has lifted the market here. Henry Hub is trading up about 10% now, and many of the gas names are up as well in sympathy. But we have a long way to go. The private operators are big players in the gas space as well. Associated gas from the Permian is massive, and with crude sitting here somewhere close to $77, wasn't too long ago it was 80. You're going to see associated gas production come on through as well. The saving grace for the operators is that we do have capacity constraints on the takeaway side, whether it's Permian or whether it's up in Appalachia in the Northeast where I am. So that could be a saving grace from the prospect of capacity and supply growth. At the end of the day, operators, investors really don't want to see the output growth, and they're rewarding the companies today, putting out production cuts across the board. Chesapeake is up nicely. And in fact, most of the nat gas complex in the Northeast is up in sympathy of that. But year on year, nat gas production will be higher this year versus last year. It's just a simple fact. We think it'll be up in the low single digits. It'll still be up. What we do need is a demand side to come on through. Winter hasn't helped, so we move on from there. But sub $2, I don't think it's sustainable. It's simple.
Sounds good. I'll fire up the grill this weekend and see what I can do to help out on the demand front. Vince, just curious, one of the big themes that we've been talking about, I think every time we've had you on, your companies are heavily involved in sort of this M&A trend we've been seeing. Most recently, you've got some news, and you've got a react out on the Endeavor Diamondback deal. So tell us about that particular action and kind of what you make of it, and how things are, what's been the response in your space to all of this M&A.
Yeah, look, when you're selling a commodity and the commodity is being pressured by civic action, regulatory political pressure, the one thing that you have to do is to find efficiencies and greater productivity. You're selling a commodity, it's really no difference in what's sold here or what's sold in some other state. So size does matter, efficiency does matter, and we're at the point where we're past this growth cycle in the space. We're no longer talking about delineating acreage positions. Now it's about finding a runway to manufacture the output, and companies need to become sizable. We're going to have fewer but larger producers in the U.S., both on the oil and the gas side. Diamondback is one that has as its mantra, as its strategy, to grow by consolidation. And they have become the largest, or will become the largest, most significant independent publicly traded operator in that space. Buying Endeavor, Endeavor being for sale was not a secret. They've been out there for quite some time. It is a sizable acreage position, and it does position Diamondback quite strongly because of the contiguous acreage, especially in the prime location like the Midland. Fernando's names buying into the space definitely incited or accelerated a consolidation trend that had been going on. It remains to be seen what happens to Mewbourne, which is another closely held, large private operator. They've said they're not for sale, but people sell at the right price, and it does have a sizable acreage position. There is such a thing as scarcity value, and that scarcity value rises as there are fewer and fewer names of size. It does present a dilemma for those who are smaller in size, whether you are a Matador or Permian Resources or an SM or a Coterra that don't have that size and that runway. This will continue on in the oil space, in the liquid space. We saw a glimpse of it in gas before prices cratered here. With Chesapeake and Southwestern, I think we still need consolidation in natural gas space. We need to have fewer but larger names, because at the end of the day, this is a commodity. You're seeking efficiencies, you're seeking savings on unit costs, synergies, and you're seeking better productivity across your platform.
Fernando, I want to bring you into the conversation. Your companies, the large integrateds, have also been active in terms of M&A over the last year or so. So what's your sense? Are we going to see continued M&A in the U.S. oil patch? And what are the kinds of metrics that companies are looking at when they are thinking about M&A right now?
Yeah, I think there are a few. One is the size of the acreage itself, and then the relative relation of generating free cash flow versus how much dividend you'd have to pay for acquiring that company. So I think when you look at Pioneer with Exxon, for example, the free cash flow that Pioneer had been generating was more than enough to cover its capex and the extra dividend payments from Exxon. So that made a lot of sense for them, because it also added a massive tail of inventory that they can now optimize and high grade their own holdings. There's still a premium for having contiguous acreage and acreage that adds that bolts on to the existing footprint for that operator. So you'd have to kind of put together who is neighboring who to see what makes sense. But we definitely see more room for consolidation. In ConocoPhillips that we cover, close to 2 million barrels a day now of production. They were rumored to both be in the running for Crown Quest, which wound up with Oxy, and for Endeavor, which wound up with Diamondback. So they could be on the lookout. And they're, other than Melbourne, which is a little bit larger than Endeavor, I think Vince has listed two other companies that are over 100,000 barrels a day, which really starts to be more exciting for the ConocoPhillips of the world. They could make some smaller acquisitions. That has never been a deterrent, but obviously it doesn't move the needle as much to buy a 50,000 barrel a day producer versus 100,000 barrels a day. I think there will be some look into emerging frontiers, West Africa being one of the regions. Chevron's already there, but there are other players that have looked at that region. And then I think there's a huge opportunity in Mexico that will hopefully be unlocked over the next few years. The national oil company, Mexico, is struggling heavily with its debt profile. The government's about to change there, and they probably will have to make some changes, include reopening. They started an opening up process, and then that was thwarted. There are a few discoveries there already that could be developed very quickly if there is a change in policy.
Okay, thanks, Fernando. Patricio, I want to come over to you and get your sense on M&A within your space. I will note that one of the companies that you cover, Iberdrola, actually, I believe, terminated a plan to buy PNM resources in the U.S. recently. So, how do you think about M&A in your space, and how are your companies chasing growth opportunities? Is organic growth, M&A, none of the above? Give me a sense of what's going on.
Sure. So I think it's clear to say, to start with our sector, European utilities are the most indebted, or highly the sector with the highest leverage relative to other sectors. So yeah, our utilities are not in a spending spree to go out and buy big targets. In effect, or actually, Iberdrola's case was very much a case of a delay. So they pursued the acquisition of PNM resources in the U.S. For over 4 years, and the regulators kind of came back and said to them that their plan wasn't good enough, that they didn't see the clear benefit for ratepayers in the U.S. From the acquisition. They didn't believe that the cost synergies were going to materialize, and well, all this back and forward kind of made the deal extend for over 4 years, and they finally terminated the deal in January. And this was an $8 billion deal, which is a sizable, it's a sizable mark within our space. And we do believe that the company will seek another acquisition target in the future, but perhaps not as large. We did publish a note about it a couple of weeks ago, and we think that the name of the game in our space really is capital discipline, capital restraint. Utilities are trying to climb back their spending in renewable power generation, and trying to stick to their sort of where they have an advantage, which is in the transmission and distribution grids, which tend to account for higher debt costs and also offset inflation. So when utilities invest in grids, they get reimbursed basically for all their borrowing costs. And since right now borrowing costs are going through the roof for companies as they refinance, it seems like yeah, no brainer to invest in grids and transmission and distribution grids, which by the way also benefit from longer term trends seen in the electrification of demand, especially here in Europe. So we've seen sort of a paring back of spending, going back to basic, investing in Europe, investing in European grids, and being more selective in renewable growth.
Okay, thank you. Maybe to step outside of the M&A trend here for a second, Vince, I want to swing back around to you and just probe a little bit more on the weak commodity price environment and get a sense, what kind of natural gas price level is necessary or required for your names to produce, good positive cash flow? And you've just come out, I guess we're still in the midst of the earnings cycle. So, how do your names talk about commodity price, and give us a sense, where do prices need to be at a sustainable level in the gas patch?
So since almost all of my guys, except for a few, since all of them produced oil as well as gas, the price deck that we tend to visit is not just exclusive to natural gas. It's also included in the overall view of where oil is. And we've talked about this from time to time, that when you think about the oil spectrum, a $100 price degrades demand. A $70 price likely begins to get boardrooms a little bit anxious. So somewhere in that $80 price level is sort of nirvana, and they tend to base their programs around that $75-$80 level, with $2.75 to $3 for natural gas, for those operators like Antero or Range that also have a fair amount of higher BTU content, or a fair amount of NGLs that get exported. Obviously, that nat gas number is slightly higher. But overall, in general, when we think about programs, we think about programs in the context of oil and gas. So a 75 to 80 with a $3 handle on natty gases tends to be that range that we see quoted. A lot of times, a lot of these programs are really about maintenance CapEx, maintenance spending, not really for growth, but to generate free cash flow. To generate free cash flow because of the base dividend commitments that have been made, and also because of the formulas around supplemental payouts, which is really a function of percentage of that free cash flow, whether it's 50, 75% in some cases. But in the cases where you have operators that have done the M&A, whether it's the Diamondbacks of the world or the Chesapeakes and the EQTs, those free cash flow levels and those dividend levels tend to get walked up as we go through the process of integrating the acquired entities, where the base dividend gets a bump up on the announcement of the deal, and then that supplemental component gets walked up as well. In the case of Diamondback, for example, because of the action in the commodity markets, that supplemental component was sort of retrenched from 75% of free cash flow somewhere down to 50% of free cash flow. So in general, it does make it easier for the boardrooms to plan ahead for 2024 and really 2025 at that $75-$80 level, at that $2.75 to $3 level. I would have thought M&A on the gas side, which would be more prevalent and more pronounced heading into the winter season, was I thought balances would be a lot tighter and the market would be a lot stronger. But the winter weather really wasn't there. I still have hope. We still need consolidation on the gas side. We still need better balance in the marketplace. We still need fewer names and much larger names like we saw, like we're seeing on the oil side. So I haven't lost all hope. I think the strip will get better as we get into the second half of 2024, as more companies tend to cut their plans, their output plans for 2024. So I'm more hopeful for the back end of 24 into 2025. So talk to me next winter.
Okay, thank you, Vince. Fernando, a slightly different question. I'm not sure who pointed it out initially. I think it was from a Goldman Sachs note, but it's interesting to note that right now, NVIDIA is apparently got a larger market cap than the entire S&P 500 energy index. And so if Vince is sort of right about that range-bound oil price, 75, 80-ish kind of range, what's your sense? Can investors get excited about the energy sector with commodity price where it's at today? Does the commodity price need to go higher to drive more interest in the energy sector? What do you make of this idea that one single chip manufacturer is bigger than the S&P 500 index as well? or energy index.
Well, it's a good thing that those chips run on fairy dust and hopes and dreams. So, I think that there's more to be said about the NVIDIA market cap than there is to be said about the energy market cap per se. And especially again, in a scenario where we are at higher rates for longer. But I think ultimately there is a disconnect between the role of energy and commodities in the economy and its valuation on broad indices. I think at the end of the day, it's it's not it's not necessarily a bad thing today because we got ahead of our skis before when Exxon was the largest company in the world, public company in the world, etc. But there's certainly a point where we'll have to reflect that the oil peak is not as close as some would have us fear. It's definitely not 2030, or we're not going to stop using oil by 2030. And so this discount that's been applied because we're all going to be running on pixie dust by 2035 is going to go away. Now, whether that is because the other sectors come to oil as reality or oil goes up to its reality and weight remains to be seen. That will be a bigger part of the market dynamics that, broadly speaking, than it is necessarily for this discussion. But I think NVIDIA itself is a massive user of energy. I believe if all their AI chips get used, you would pretty much they would consume as much energy as the entire U.S. EV fleet. So it's not insignificant to see their growth on the effect of energy. So Vince's names might get a big bid because natural gas will be in very high demand if that happens.
Vince, I think you've got something to say here.
I help out the strategy guys and do some work at the sector level for energy. And, if you think about where energy was positioned as a piece of the S&P during the commodity super cycle, and think about where it is now, I think we had peaked somewhere around 15% of the S&P. We had bottomed somewhere around 2% during the height of COVID. And despite the rally in 21, despite the tightening in 2022, we're still somewhat stuck in that 4% range. And what PMs tell me, what endowments and pensions tell them is that they really don't want to see energy in that top 10 holding. So it is truly a civic and regulatory political backlash against this industry, whether it's focusing on the extractives or focusing on the things that the extractives need to move their product, the infrastructure, for example, MVP being a prime example of the issues that a lot of the infrastructure names have to deal with here, especially on the East Coast. But I definitely do think that we are in a tough spot for the broader energy space. I definitely do think longer term natural gas is a winner. And we have said this quite frequently. It's a lot of pain right now, but I definitely do agree that if you take a look at the commodity complex, the energy commodity complex, that natural gas is going to be a prime candidate, a prime winner in all of this. But you still need that consolidation. You still need those resources in stronger, better hands with better balance sheets in order to manage this process, right? We're still in this maturity stage. We're still in shakeout stage, but at the end of the day, I definitely do believe that in the longer run, nat gas does become the prime winner among the energy complex.
Patricio, we're going to come to you for last word. I'm curious, what might get investors excited about the sort of gas and utility space over in Europe. Is commodity price a key driver, or is it another set of factors that may drive interest in the kind of names you look after?
Yeah, I think, well, short answer is there isn't a lot to be excited about in terms of gas prices here in Europe. Both because, well, there's two big reasons for that. Is the economy here, or the outlook for the economy here, is very sluggish for 2024. Consensus GDP growth in the Eurozone is about 1%. So there's very little reason to think industrial activity in Europe will increase significantly this year. Or even next year. Next year is not set to be a huge rebound in the economy either. And the second big factor is that from 2025 onwards, there will be a new fleet of LNG supply, sort of a few new liquefaction trains coming in online in the US. So we actually expect prices to continue to decline into 2025 and 2026. That was our original thesis, is that the global LNG market will loosen towards the mid-decade, and we think that that's occurred a year early, just because the response in demand has been so abrupt. And the same goes for power prices. So power prices are also still driven by gas prices here in Europe. So on that front, we do expect power prices to keep declining throughout this year, and perhaps stabilize in 2025, right around where they are now, around 55 euros per megawatt or so. So basically, all the sort of, from the commodity front, all those cyclical drivers are normalizing. We're seeing more normal power prices that we saw from 2015 to 2020. And yeah, there's not a lot of excitement if you think about the sort of traditional utility. I would say there's perhaps there's been too much pessimism on the renewables sector. So that sector was battered last year by rising bond yields, and also by project delays that hurt select operators like Ørsted. So obviously, from the valuation front, that peer group has been hurt quite a bit. But we actually think that this year they will install more renewables than last year. We actually expect capacity additions among European utilities to increase by 15% this year, and I think that there could be some upside to consensus in that perhaps we've been too pessimistic on the renewable sector, and perhaps there will be some recovery this year.
Okay, we're going to have to leave it there. A couple of just quick announcements. One, I want to thank anyone who joined us at our event in Miami last week. We are trying to set up a series of events so that we're not just faces on screens. And so with that in mind, I would just quickly note that myself, Vince, Fernando, we're all going to be in Kansas City for an event on April 2nd and 3rd, I believe. So if you want the details on that, reach out. It's a big 2-day event. Our colleague Jason Miner, Brett Gibbs, a number of other analysts from BI will be there, plus some great external speakers. So if you're interested in the energy meets agriculture space, which I think is kind of the general theme of that event, please come join us. And for anyone who isn't, if you've got colleagues or other folks who might be interested in these kinds of discussions, just please join us next week. Spread the word. We're happy to hear from all of you. And there were a few questions that we didn't get to in the chat, so we'll follow up with you individually. And I hope you have a great rest of your week. Thanks, everyone. Thanks for your time today.
Thank you.